I'm here today with my friend Philippe Weberman, and he is at our fake Paris Bourse, and I am at our fake Chicago Mercantile Exchange. But our discussion of crypto derivatives strategy is real, and he comes with quite an interesting business background, which you'll hear about on later podcasts. But I think he wants to ask me some questions about our new strategy for crypto money fund dollar hedge 2, our hedge fund.
Hello, Nicolas. Good to see you.
Bonjour, Monsieur Financier.
So here for the first question, Nicolas, can you please explain the core principle of your carry trade strategy and how it contributes to capital preservation?
Yeah, basically, the carry trade is simply buying an asset and then selling it immediately on the futures market, or basically simultaneously using a computer. So basically, you buy Bitcoin at $40,000 and sell a future for, $41,000 or $42,000. The difference is your profit. And the reason it leads to capital preservation is that it's very hard to get in trouble on this particular trade. These are coin delivered contracts on crypto exchanges. And so we've already put up for collateral the coins that we promised to sell. So it can't go bankrupt. So contractually, there's very little that could go wrong. Things that you should worry about and are minor risks, but risks are the counterparty risk, like the exchange could be FTX or something like that. We don't believe that's the case in our case, and we've traded before and after the demise of FTX on these exchanges, and they're very reputable and give proof of assets and things like that. And then also, the thing about the carry trade is if the market craters, you're not going to lose any money. You'll actually gain some because the asset you already sold will be cheaper to buy back. However, there are times on the crypto exchanges, there's auto liquidation. So you think you're hedged, but you're not. In the middle of the night, they could just cash out of the position. And we're very vigilant about that. It's certainly happened to me before. The trade, it was before I was even a fund manager. The trade worked out well because the asset recovered. But you're not following a strategy if you're not hedged. Okay, forgive me. I get excited about crypto derivatives. Next question.
Thank you. Very clear answer. Second question: how do corporate call fits to your overall investment, and what advantage do they offer compared to direct Bitcoin investment?
Okay, so they fit into our strategy as a way to add more income. Like basically, you're selling an option that will most likely expire worthless. It doesn't always, but in general, it should. So it should add some return, maybe 10% per annum to the Bitcoin return if we do it right. What other advantages? I would say it smooths out the value, because even if Bitcoin drops, we've achieved some income to offset that loss by selling a call. So let's see, this was a carry trade overview right here. This is the covered call, so it's kind of small. I would just refer you to our webpage and the investment strategy tab, but it shows that it can certainly earn more money than simply investing in raw Bitcoin. Now there is some risk that it will chop off some of your return if the market really jumps up and you get called, but on balance, it seems to contribute income and offset losses.
Okay. Question 3. Could you describe the decision-making process behind shifting to cash or cash equivalents when Contango yield approach or fall below 90-day treasury yields?
Yes, I would love to describe that. I mean, basically, it's a straightforward binary decision. If at the beginning of the quarter, Contango earns 0, then and Treasury earns money, there's no reason to risk our clients' money by putting it in the Contango trade. It doesn't have downside over a quarterly basis. It's just something attractive might pop up during the quarter, so it makes no sense to do it. So a very good indicator is if the same 90-day period of treasury yields is higher than Contango trades. Simply don't do it. And other opportunities that we'll probably even talk about today may pop up. But I'll give you an example. If you look at our chart here, this is remodeling a period when we found nothing, and as it turns out, there was nothing in 2022. I mean, we did make some money, and we returned investment to our investors at the end of the third quarter, not having experienced a huge market drawdown that everybody else did. But it's still, there are times when there's simply nothing going on in Contango. There's no basis trade.
Okay. Question number 4. What inspired the development of the butterfly strategy, and how does it help in handling unpredictable market scenario, including black swan?
Well, okay, to answer the first question first, someone mentioned it to me, I read about it. I just found it intriguing because, again, it is a market neutral strategy. If it moves too far in any way, you simply lose the money you put in. Now, in Bitcoin options are still a lot less liquid and efficient than, say, S&P options. So there are opportunities where you can actually be paid to enter a butterfly where there's no risk. Our system isn't quite online yet, but like we're going to be scanning that day and night to see if we can get paid to enter a trade where there's only upside. So that's obviously an attractive trade. Now, what would happen in a black swan event? Well, of course, we're still investigating and testing it for ourselves. But I'll give you an example. Let's say someone's selling puts on S&P 500 options at the money. Now, their rationale is very simple. They're just saying, look, we want to own the S&P 500 basket. This is an attractive investment, right? So what's the worst thing that can happen? We get income, and then the market goes down and we get put. But at least we bought that index at a discount because we got some cash up front in order to enter the trade. What could possibly go wrong? Well, there are mutual funds that have invested in a strategy that's only on that side of the trade. They're only selling one option. It may be cash covered, but like piling up huge losses, people are human, and it's pretty hard to look at. So the structure of a butterfly, and we're going to spend a whole nother video on it. I'm going to say this very succinctly. You buy one in the money call, you sell two at the money calls, and then you buy one out of the money call. It works with puts also in the same proportions. So the at the money call is actually the one that's at the money of the S&P 500 index. Let's say it craters and all of a sudden those securities start going through the ceiling in cost. These people have already sold them. They may ride it out, but they may just need to buy them back. So the part where you sell to is dramatically inflated. You sell at dramatically inflated prices. I'll revisit this, but I'm just saying things don't work completely perfectly in the market all the time. Things return to formula, but they don't stay there all the time. And there may be some opportunities, especially if you have a Linux box, a computer searching day and night, and it doesn't get tired of looking.
Definitely. Okay, next question. Question number 5. How do you balance traditional investment methods with innovative automated system in your strategy? How do you balance both?
Well, there's really there's no contradiction between the two. The primary difference is that computers are much more disciplined. So I'm still a human. Like pilots do better when they follow the autopilot. I'm a trader. I'm basically just following the autopilot. But since there's a lot of money, including my own, like a lot of my life savings in this hedge fund, if things go drastically wrong, I want to be able to pull the trigger on it and trade out of whatever the positions are. But honestly, so far, I mean, there have been problems with the automated trading, but it does, on balance, a much better job than I do. So there's no contradiction whatsoever.
Okay. Question number 6. Can you discuss any specific challenge you faced in implementing this multifaceted strategy, and how did you overcome them?
Well, I mean, there have been several challenges, but mainly it's just trust. Like someone tells you to do something different with a lot of logic, and you think about it instead of acting on it right away. But I can tell you in both of those cases, it cost us money. The first trade I saw when on an experimental basis, our butterfly was working, I waited for a day and it paid off a little, but it would have paid off a lot, like 5 times our money if I'd hit it the day before when it popped up in the system. But I didn't just quite trust something new. Similarly, recently, there was a huge run up in Bitcoin to the ETF offering, and then it fell off. About that time, the quant, we hired a really talented guy, private, we don't mention his name, but he'd worked at Citadel and other, really big places. And he just said, yeah, in essence, and it's on our strategy page, the low risk trade is not necessarily less risky over time in a portfolio. I'm sorry, less lucrative. So same thing, I would have saved tens of thousands of dollars if I just rebalance the portfolio, as he said that day. Now, of course, if you believe in efficient markets, you don't want to bank too much on where it goes the next day. But I'm just saying, both of the times these guys gave me, the one guy through a computer and one guy verbally gave me spot on advice, and I walked around in circles and didn't follow it. So if you commit to a strategy, just commit right away and start doing it.
Okay. Thank you. Question number 7. Looking ahead, how do you anticipate the investment landscape change? And how is your strategy positioned to adapt to those change?
Well, it's a blend of art and science and working with strategists and coders, but stuff is always all markets are dynamic, and the Bitcoin market is really dynamic in the derivative market. But I'll tell you one thing that we're looking for. For example, the volatility of the prices, the futures and options is basically based on historic records, right? And it could be declining as more money goes into the marketplace. So one thing that we're looking at right now is the actual realized volatility versus the implied volatility in options pricing, and that's one thing, for example, that is constantly changing, and we should really keep an eye on. But I mean, that said, also just sometimes I have followed the strategy that was ultimately suggested to me on a rational basis by just seeing something totally out of the ordinary. Like I had already shifted more money into the safer Contango strategy just because it was yielding 20% interest. And I've kind of noticed in the past that when the safe trade is really attractive, then the riskier trade, the risk is shown. It's sometimes the market craters, and that's exactly what happened. And conversely, it's true also if the futures market's in backwardation. I've noticed that you're really looking at a rise in a quarter or so. So that said, it was like the first time I really based anything on it, but I was right and proven later by the quant. I wish I'd just gone more into the trade as he had said, because he was right and it paid off immediately. So okay, that's just one of many answers I could give.
Okay, thank you. Question 8. Could you share a specific success story or a learning experience from using investment strategy?
Well, I think the major success, I would just look at our webpage. I mean, before we have a fairly safe portfolio, even in the second fund, which is not as hedged as the first one was. But pursuing that, we basically tripled our investors' money between the third quarter of 2019 and the third quarter of 2022. And then this last year, we returned I forget how much it was, about 120% to our investors, 90% after fees. Now, the Bitcoin market was very good also, but I'm saying even with downturn, our hedges showed that mitigated the loss a little bit, and it will mitigate it more in the future. So I would just say, look at our record. I mean, it's a record of success, and I'm very proud of it. And you go, Alonzi.
Yeah, question 9. How do you measure the success of your strategy, and what metrics do you consider more important?
Well, I mean, I think that now we have some really clear guidelines from our quants about what our variance and returns are and how much we should make. Basically, the Sharpe ratio, SHARPE in finance. Are we getting rewarded for the risk? So there's a very clear answer to that I can share with investors. There's some other sophisticated analyses that we are beginning to run that we wouldn't before. For example, is the volatility on which our options are priced really up to date, and we can do our own analysis of the last quarter. So now that we hired a real pro to help us look at things, we might have a slightly more sophisticated way of looking at that for the next few quarters.
Okay. So question 10, finally. What advice would you give to investor looking to implement similar strategy in their own portfolio?
Well, I'd say two things, and then the third that I want to say, but I can't say it yet. The first one is, I mean, when I say advisors, I don't mean a financial advisor who charges you a percent to make less money than you would just buying stock indices. They are understandably useless unless they're really helping you with things you don't understand, like how to have enough money liquid for the next quarter or something. But I mean, when I say seek out advisors, I was like totally shocked at talent that's available out there in the more fluid workplace. So I've given a speech once on using Moneyball in your business, like the Brad Pitt movie where he's the Oakland A's coach and helps them to do well by finding underutilized players. There's some underutilized players out there ranging from, and I'm not going to name names, but like a guy who was a City of London analyst who has a Greek restaurant and living on an island now, and just thought that would be a really cool thing to do, to this guy who worked at Citadel, just opened up his own shingle and is available to give incredibly talented work that like the top guys like Ken Griffith could have expected and did because he had trained him and I'm working for him, and now guys like me can pay for it. So that's real benefit. If you're going out as an entrepreneur or trader, like seek those people because they do have the experience that frankly I don't, and they can really up your game. Also, I would say, given our tiny size in the first and second fund, you wouldn't necessarily think that we would be engaging in automation projects at like a Chase Manhattan Bank. Sorry, I'm so old. JP Morgan Chase or whoever could afford. But it probably makes sense to code it. Outside packages and firms are probably going to be too expensive. But if you sit down and work, and actually maybe use AI to help translate and work on the way, you can work with coders and quants to replicate that Major League Ball team that was Citadel or whatever, and get some of the same results yourself. And this is, again, a topic for a whole other podcast, but you do have a few advantages of being a David and not a Goliath and dealing with them. So I mean, I'll give you some examples in my own case. So that's all I have for today, but I feel like when you get the wind up bunny started on crypto derivatives, I just talk and talk and talk. So forgive me if I was too verbose.
No, it was very interesting. Thank you very much, Nicolas.